what you're probably missing is that that return actually includes improvements to the property, includes all the money that you're putting into renovating it, to fixing things in the property, and that fixing cost can amount to at least 1 or 2% per year. Hi, I'm Chris, the founder and CEO of StockSpot, which is Australia's largest online investment advisor. And in this video, I'm going to be answering a common question we get from clients who are looking at different ways of investing their money, which is, should I buy an investment property or a share portfolio? And I must sort of say up front here that I am biased in this regard. I've been investing in the share market for 25 years or so, and I think it's a great way of building wealth over the long run. But actually in this video, I'm going to go into the details of why I think investing in shares is something more people should consider compared to investment property, because I do think it gives a lot more flexibility, diversification, and other benefits that people don't consider. But also there are some big downsides of investment properties that I think people don't realize until you actually have bought your first one. So the first reason I think shares or a diversified portfolio makes a lot more sense than investment property for a lot of people is diversification. That's all about spreading your risk. And when you invest into shares, you get to spread your risk across a whole bunch of different companies and sectors and industries and countries, which means that at one point in time, one thing might be doing well, one thing might not be doing as well, but it all kind of evens out to give you a more smooth path to growing your wealth. Now, that's not the case when it comes to investment property, because typically if you're investing in investment property, you might only be able to buy 1 or 2 or 3 if you're lucky, and they're likely to be in the same city, in the same country, so you're not very well diversified at all, and you're really prone to the ups and downs in that particular market. So shares give you a better way of spreading your money and actually reducing risk, and that is risk that you don't really need to hold as an investor and need to be exposed to. So the second reason would be the cost to buy and sell. So when you're investing in the share market, particularly low cost exchange traded funds, like the ones we recommend to StockSpot clients, it's really cheap to get in and out. So you'd be unlucky if you paid more than about 0.5%, 0.5% to buy and sell securities or shares or ETFs. Whereas when it comes to investment property, the round trip cost is something like 7%. So there's lots of research that's been done in Australia that says the cost of buying an investment property, and that involves conveyancing costs and property taxes, is around 4%. And then the cost of selling a property, including agent fees and advertising fees, is about 3%. So all up, you're looking at a round trip cost of about 7% that comes out of your return. That is what I would describe as slippage, a loss of your return that's unnecessary and is avoidable if you're actually looking at the share market. So the cost of getting out is another one. Once you're into property, the other thing to consider is historical returns. So what we know is from the share market over the long run, and if you're looking at periods of 20 or 30 or 50 years, the Australian share market and other big markets have returned in the vicinity of 9 to 11% per year. That includes both the capital growth as well as the dividends produced by these companies. The property market, there's been some research done by the Australian Bureau of Statistics that's found over the last 32 years, and that's to the end of 2019, the property market in Australia put on about 7% a year. And you might think that 7% a year is pretty close to 9 to 11, and actually we've had even better returns since 2019. So maybe it's 8 or 9% per year now. But what you're probably missing is that that return actually includes improvements to the property, includes all the money that you're putting into renovating it, to fixing things in the property, and that fixing cost can amount to at least 1 or 2% per year. And so while it may look like a 7 or 8% return, it is more likely to be a 5 or 6% return when it comes to the servicing of that property and the maintenance of that property. And I think that's a cost a lot of people ignore when they're looking at the long-term returns from property. They're forgetting that in order to access those returns, you have to invest a lot into it. Now, the tax office actually shows that you can depreciate the cost of a residence over 25 to 40 years, which means that actually there is a reasonably large deterioration in the value of the actual residence over time that you're needing to maintain. Now, that doesn't happen with the share market. You get the dividends, you get the capital returns, and you don't have to pay a cent to maintain it every year. And that's another reason I prefer shares over investment property. The next one is that you're at no risk of missing out on income with the share market. So when you own a diversified portfolio of shares, you're going to receive your dividend check every year. There's very little chance, particularly if you're diversified across a whole bunch of companies, that there's a year that no dividends come or a period that no dividends come. But that's not the case with investment property, because while you can have the best intentions to have it occupied the whole time, you can have a really good real estate agent that's helping you and property manager that's helping you fill it with tenants. There's a good chance that at some point it's going to go untenanted. There's going to be a period of time where you don't have any rental income, and that's not a problem you have with shares, but it is a problem when it comes to investment property. The next benefit, I think, of shares is that you don't face the issue of negative gearing. So a lot of people think negative gearing is a positive thing in Australia, that you get to write off some of your, some of the cost of owning a property and the interest you're paying off your income. But really, this isn't such a great benefit, I don't think, because ultimately it means you're losing money on this property between the difference of the interest you're paying versus the rent you're receiving. And so really you need capital gains in order to make your property worthwhile and actually give you a positive return. Now that doesn't exist in the share market. You don't have the problem of a negative overall cost of owning it that you need to overcome through capital gains, which can become quite an expensive burden to carry over different periods of your life. Another benefit, I think, is liquidity. So when it comes to selling shares or a portfolio of ETFs, you can do it like that. In Australia, you can sell it on the ASX and receive the money within 2 days, which is the T+2 settlement period in Australia. Certainly when we're selling portfolios for our clients, they get the money within a couple of days. Whereas when you're selling a property, it takes time. It takes time to find an agent, to put it on the market, to advertise it, to organize inspections, to organize the auction. And then you might not get lucky and it might not even sell, and you might have to repeat that whole process. And so you miss out on the liquidity benefit when you're investing in investment property. And you're also very reliant on the market environment at the time. So it could be a good time to buy, or it could not be a good time to sell. And you never really know. And it may not suit you to be selling at the time that it's best to sell at. Which actually then leads me to my final point, which is about selling part of the share portfolio. So when you're investing in shares, the great benefit is that you don't have to sell it all at once. You can invest $100,000 in shares and decide you need to sell $10,000 because you need that to cover some living expenses or pay for a holiday, or you need the money to invest in something else. With property, you can't do that. It's all or nothing. You can't take a little bit out of your property. You have to sell the whole property if you actually want to realize that money to invest or do something with. And so you really miss out on that ability to sell a partial element of your portfolio. You have to sell it all or nothing. Now, there are lots of counterpoints to these, and I think the one that I see come up most often is that when it comes to investment property, you get a big benefit of leverage. And that means that you can go off and put down the $100,000, but borrow $400,000, and it helps to magnify your returns. And I think this is true, certainly in an uprising market, having the magnification of your returns is positive. But the two counterpoints I'd make is it works in reverse when markets are falling. And so if you're not in a rising market, and there are plenty of cities and areas in Australia that haven't been as strong as, Sydney and Melbourne and some of those bigger cities, if you are leveraged and you only own a part of the equity and you have a lot of debt and the price isn't rising, it can cause as much harm, or if not more harm, than it would have provided benefit in a rising market. And the other counterpoint is shares also offer the same ability. So it is possible to get a margin loan, which is borrowing money to invest in shares to get that leverage exposure. It is more risky, and it's not something we recommend at StockSpot. And actually, I'll put a link below on another video I've done about whether we recommend margin loans with investing. But the point is, if you want to do it, it's possible at a similar rate to actually getting a mortgage, and you get all of the benefits I've discussed before about the share market with the benefit of leverage as well. So that's a summary of why I think investing in a diversified portfolio is a far superior long-term way of growing wealth compared to buying investment properties. Of course, I'm biased. It's what I do for a living, and it's what I've done for 25 years. And I feel like I know it pretty well. And certainly it hasn't done as well compared to the property market over the last few years. And there's always going to be periods where property does better or vice versa. But I think the benefits in my mind way outweigh the costs of investing in this way. And that's why, for my personal preference, shares in a diversified portfolio beats investment property. However, I'd love to hear your comments, your experiences, your views on this in the comments below. Have you had a good experience buying investment property? Have you had a bad experience? What's your investing in diversified portfolio experience been? Have you had both? Have you been able to compare the returns? I'd love to hear your comments, so please comment below. And if you like this video and other videos about personal finance, investing, property, shares, and ETFs, please subscribe to my channel, and I'd love to share more videos with you.